Did you know the game of property investing has a set of rules? And guess what? Those rules are owned by the banks. It's super important we know the difference between a principal and interest loan and an interest-only loan. Let me go through it with you right now. When you've got your own home, so if you've got a $500,000 property and you've still got a $400,000 mortgage, and if you decide to have a principal and interest loan, so the repayment's going to be $2,500 a month. So here we go, Captain Obvious. There's a principal component and an interest component. So did you know there's quite a small ratio of your principal and interest loan that starts now basically salami slicing the loan off. So you got like $500 a month, goes onto salami slicing the loan, and the other $2,000 a month goes somewhere. I'm about to let you know where that goes now. Here's a quick concept for you. Who's heard of the thing, rent money is dead money? Well, guess what? You know, everyone's like, yeah, I've heard of that before. Guess what? When you've got an interest component on your principal and interest loan, that is also dead money. It just goes into the big black hole of the banking. It's basically like you paying rent to the banks for the privilege of having your home loan. As time goes by though, basically the ratios change. So as you continue to now pay off more and more of your home loan, your $2,500 a month, which pretty much stays constant, you're now basically paying more principal and less interest, so you do start to pay off your home loan a little bit quicker. Here's an interesting concept. Some of you might have heard about, what if I pay an extra $100 extra off my home loan every month? What that's going to do is basically now bring your home loan down quicker, and you're going to now inject some redraw funds into your loan because you're effectively paying it off a little bit quicker. In summary, what that all means though from a principal and interest loans perspective, you can see here principal in the blue, interest in the red. In the first 1 to 5 years and the first 6 to 10 years as well, it's mainly all interest. You're actually not salami slicing your loan off very much at all. You can see clearly the loan, starts to get paid off quite quickly towards the end. So what does that mean from a generic estimation perspective? Between the tenant, between the taxman, and between yourself, there's almost like a healthy little ratio there about who's paying the mortgage. Conversely, if we choose to go and do an interest-only loan, whereby the first payment is the same as what the last payment is, you're not trying to, salami slice the loan off yourself. You're just putting the right holding strategy in place. And what does that holding strategy mean? Between the tenant and the taxman, with no input from you, you're able to have that property sitting in the right market. Get your mindset right. Make sure you've got a healthy combination between rent and tax. All you're trying to do is buy time here so you can have that property in 10 years' time.